How could you explain a sudden collapse in the price when the market was looking bullish, or sudden rally when the market looks dead? This is what we are going to learn in this episode. Welcome everyone to another technical analysis episode. My name is Mr. Crypto Tracker, and in this episode, I'm going to talk about market structure. So stay with me until the end of this episode. Before starting this episode, please make sure to subscribe to the channel if you didn't do it so far, and turn on the notification bell on, then you will get notified when the new video comes. If you pay close attention to the market, you will realize it moves in stages, and we have different stages in the market. The first stage is accumulation stage. Then we have advancing stage. After that, we will have distribution stage, and the last stage would be declining stage. This means if you know what stage the market is at, you will never have to second guess what you should be buying or selling. So let's start with accumulation stage. An accumulation stage occurs after a decline in price, and it looks like a range market within a downtrend. When that happens, you've got traders selling in the downtrend and traders buying at cheap prices. Now it's called an accumulation stage because it is where the smart money accumulates their position in anticipation of higher prices to come. Here are the characteristics of an accumulation stage. The first characteristic is it occurs after the price has fallen over the last 3 to 5 months or more. It looks like a range market with obvious areas of support and resistance within a downtrend. The 200-day moving average starts to flatten out, and the price swings back and forth around 200-day moving average. These are a few characteristics, but it doesn't mean all of these characteristics should happen at the same time. So let's take a look at an example. So here we have a clear downtrend. It was one of the requirements. And then after a period of declining in the market, which starts from here and it takes more than 1 year. So the other characteristics which says it should take more, at least 3 to 5 months. It happened more than that. And after this decline, markets find a good area of support. One support here, support, and support here. And we can say accumulation stage happens here. So just because the market is in an accumulation stage, it doesn't mean it will break out higher. It can also break down. And if that happens, the downtrend resumes. And if we have two periods of accumulation, like for example, if we identify this area and we tell to ourselves, so it is the accumulation stage, but instead of price going up, it starts to going down again, then we should look for another area of accumulation, and we call it reaccumulation area. So this is for the accumulation stage. So let's move to the next stage, which is advancing stage. The advancing stage occurs when the price breaks out of a resistance from the accumulation stage, I mean. This happens because the market cannot remain in a range forever. Eventually, one side of the market will dominate, and that's the start of a new uptrend or resumption of the downtrend. So here are the characteristics of an advancing stage. It occurs after the price breaks out of resistance in an accumulation stage. You will see a series of higher highs and lows. The price is above the 200-day moving average, and the 200-day moving average is starting to point higher. So let's take a look at an example. So after we had this accumulation stage, and then you can see the price breaks out of this resistance to the higher, and the advancing stage just start. So you can see higher highs and higher lows, And again, in the advancing stage or any other stage, we can have different stages again. So for example, here in this advancing stage, in this area, we have another accumulation. So what is important for us is the general structure of the market. We just talk about the long-term view, the high time frames, not going deep into the low time frames. So keep it in your mind. The next stage is a distribution stage. A distribution stage occurs after an advance in price, and it looks like a range market within an uptrend. The logic behind this is that the market can only go to high prices before the sellers come and short the market. When this happens, you have got traders buying in an uptrend and traders shorting at high prices. When these two forces collide, the market goes into an equilibrium, which is known as the distribution stage. At this point, it's called a distribution stage because this is where the smart money distributes away their position in anticipation of lower prices to come. Here are the characteristics of a distribution stage. It occurs after the price has risen for the last 3 to 5 months or more, definitely on the daily time frame. It looks like a range market with obvious support and resistant areas in an uptrend. The 200-day moving average starts to flatten out. The price swipes back and forth around the 200-day moving average. So let's take a look at an example. Here we have a clear uptrend. Then the distribution stage starts. You can see the 200-day moving average starts to flatten out. The steep angle it has, we can see it's going to disappear here, and then the price moves around the 200 moving average, like a short period above, then below the moving average, and we call this type of price action a distribution stage. At this point, there is no guarantee the market will break down. This is an important point. But if it breaks below the support, that's where we move on to the final stage. So here we have the support, and if the price breaks the support to the downside, then the last stage of the market will start from here. So the last stage is declining stage. The declining stage occurs when the price breaks down of the support from the distribution stage, which is known as a downtrend. This is because the market cannot remain in a range forever. Eventually, one side of the market will dominate, and that's either the start of a new downtrend or the resumption of the uptrend. So for a declining stage to occur, the selling pressure must overcome the buying pressure, which leads to the start of a new downtrend. Here are the characteristics of a declining stage. It occurs after the price breaks out of support in a distribution stage. You will see a series of lower highs and lower lows. The price is below the 200-day moving average, and the 200-day moving average is starting to point lower. Let's take a look at an example. Here we have the distribution stage, then the price breaks down this support, and then the declining stage starts to happen. If you can identify which stage the market is in, you will know whether to be a buyer or seller. If the market is in a potential accumulation stage, then you know there is a huge potential to the upside. And if the price breaks above the resistance, you will want to look for buying opportunities, perhaps near the lows of the support or the breakout of resistance or the first pullback after the breakout, or whatever situation. There will be times when the market structure is unobvious. So what do you do in this scenario? You have to stay out of the market. That's obvious. There are plenty of trading opportunities with cleaner market structure. So don't force yourself to trade if you don't have a read on the market. So this is for different distribution stage, and I will go on different charts, and we will try to identify these stages on the chart together. So stay with me. Still, we have a few points to talk about. Okay, let's take a look at the Bitcoin chart. Here we have the Bitcoin chart on daily time frame. I use the 200-day moving average here. You can simply add it to the trading view. And based on what we learned, we can take a look at the market to see what we can find. So here we have a clear downtrend. Let me change the color. And after this downtrend, you can see this area. It looks like accumulation. So we have support here, then price finds another support in this area. You can see the support here. Actually, these few candles here, you can see, we call it fake out, or in the coming episode, in the next coming episode, I will talk about this area in more detail. So here we have a clear support, and here we have resistance area, and you can see the price breaks out of this resistance and pull back to it. So in this pullback, or at least in this area, you can insert your long trade because you already identified the price. It was in a clear downtrend, then accumulation, and the next stage probably is an uptrend. Yeah, and you can see the uptrend starts and it goes for a very long time to the upside. So this is a clear uptrend, and after you identify this accumulation and this this breakout of the resistance in accumulation, you can start buying in like situation like this. After any breakout, you can enter, or you can wait for a pullback like this, and then again you have another high here, and again you can look for a buying opportunity at the breakout or in the pullback. So this is a clear uptrend, and then price reached to an all-time high. It's the 2017 all-time high, and it starts to go down, just as a downtrend. And in this area, you can say we had some sort of accumulation, or you can call it distribution from here to here. And yeah, you can consider it as accumulation. And here, this interesting here, after we think we find a good accumulation area, you can see price breaks down of this accumulation, and then this is where we can call it reaccumulation area, or we can call this whole area as distribution and then accumulation. So it's not like a textbook to define a few rules and just look for those rules. You have to be flexible to the market, because market is not rigid, market is flexible, and you should adapt yourself with this flexibility. So after this, you can see a very clear advancing to the here, and again market enter to a period of, you can say this is the distribution, and then price breaks down, pull back to the distribution, to the support of the distribution, and starts to go lower, and again we have another period of consolidation, accumulation, and then again advancing. So this is how you can go on different charts and try to identify different stages of the market. And also it would be good to go to higher time frames if the chart you're trying to find different stages of the market has enough history, then you can go even to higher time frames like weekly and monthly, and again the story is the same, and you can apply the same rules and find different stages of the market. For example, here in the weekly time frame, we can call Bitcoin, this area was the distribution area for Bitcoin, and then a declining stage started, and still we don't know whether the declining stage finished or it can continue. So what is clear for us is we have an area like this. For the time being, we can call it accumulation. If the price breaks to the upside, we can look for buying opportunity, and if it breaks to the downside, we can look for a short opportunity. So this is for today. Please go to different charts and try to identify different stages of the market. And in the next 2 episodes, I will talk about other aspects of market structure. So see you on the next episode.